Coming Saturday on 28 June, we have 3 power-packed webinars only for you. On 10 a.m., how to turn your dreams into financial milestones. On 11 a.m., energy transition for Viksit Bharat, sustainable and net zero India. On 11 a.m., we also have a Kodishwari special women-only webinar on how to plan for your daughter beyond just marriage. All the 3 links are in description. Go register for your webinar today.
Talking about risks, so given the current valuations, how should an investor approach? Do you do lump sums or do you do staggered approach? How do we kind of do it in these kind of?
See, in this, I don't wear a different hat, whether I am an investor for myself or for others.
Yes.
Fundamentally, one dharma applies to investing.
Right.
Always be fair in what you pay, whether it's for yourself or for others.
Right.
You can't violate that in the name of asset gathering.
Right.
So, if you see the fund houses which keep 25% cash, broadly are trying to adhere to that dharma.
Right.
Now, as investors, we have followed this all our life. It's not different. But when it comes to doing professional work, we should not compromise on this.
Yes.
Okay. That is what the fund house is doing. That is what many advisors also can do. That's what we can also do. It's not very difficult. Not very different either.
Correct.
So, broadly, you take on only decisions which you find acceptable to your sense of correctness.
Stock specific.
Very investment specific decision making. So, in this period, I like to be extremely investment specific. So, I may like a stock. For example, I may like a bank stock.
Yes.
But I will not buy that bank at a valuation which is not comfortable to me. I'll wait for the valuation to come to a reasonable zone of comfort, even to start investing.
Correct.
Then how does the position get built? When the stock price comes lower, when the valuation comes more and more into my zone of comfort,
then we can.
Yeah, it's like if you're going hunting, you draw the prey into your territory and then hunt.
Yes.
This is what.
Correct.
You don't go
and take more risk and jump
into the other territory.
Yes.
So it's like that. So valuation territories are there.
Correct.
Our territory is where we are comfortable.
Correct.
The other territory is where we are out of water.
Yes.
Fish out of water.
Correct.
Where we are not in a comfort zone. Where the terrain is not our terrain.
Correct.
So this overvalued and buy at any price terrain is not our terrain. Our terrain is where the valuation is reasonable.
Correct.
We start where the valuation is reasonable. We only focus where the valuation is reasonable. We deploy where valuation is acceptable.
Absolutely.
When that acceptability increases, we deploy more.
Correct.
When we have exhausted all the money of the client because the valuation comes down, we reach out and say, boss, give me another 5% capital or 10% capital.
Correct.
When I get another opportunity in some other place or in the existing places, I'll put a little more. I'll do a little bit of scaling up.
Correct.
So, this is no different from how I would invest for myself. So, when we wear the hat of investment advisor, mutual fund distributor, portfolio manager, okay, somebody who's running a PMS, let's say tomorrow even we do asset management.
Yes.
I think that we have to wear the hat of the investor all the time.
Absolutely.
I'm not in that camp which says that here I am a supermarket, I will do everything for everybody. You can do whatever you want with me. I'm not in that camp. I believe that you have to create a certain philosophy by which a lot of people can invest comfortably by believing in that philosophy and scaling up by practicing that philosophy in their investing, where you are hand-holding guidance, management skills.
Taking only appropriate risks.
All these things support them.
Yes.
Okay. If somebody is very comfortable with one scheme in a fund house as their whole portfolio, what it actually shows is that that fund scheme has built that trust in the mind of the investor that, bus, right? That feeling has come to people and they're doing that. My aesthetic is to create a portfolio which gives them the same feeling. That's all. Because I don't want to be a slave of only one product or one philosophy, but I want an overarching philosophy to apply for the client, inside which there are lot of layers which the client needs. Right? It's not just about a product generating return. That's a very narrow way of looking at it. I think that a portfolio should generate returns. Inside that portfolio, there should be risk mitigation.
Yes.
There should be diversification when necessary. There should be investment allocations which can increase the overall portfolio returns, though the allocations are modest. I'll give you an example.
Yes.
Like I could take a silver bet of 10%
Yes.
and a gold bet of 10% in an overall portfolio, which increase the returns
Yes.
of the overall portfolio significantly. Nifty that year, last financial year, did 4.5%,
Yes.
whereas this portfolio did 18.5%.
Absolutely.
How did this happen? Because I said 20% of this portfolio has to be in a different asset class.
Correct.
Right? This year, I may do the same thing in another asset class where I am allocating higher because I feel that equity can see a drawdown and I don't want my client exposed to the risk of the drawdown. Right? Both the years we have traveled without small and mid cap. Progressively, I may think that let me create consumption as a theme, let me create small and mid cap as a theme,
Correct.
let me continue with banking as a theme, and let me stick to large cap, and then string these things together to create an equity compact, an equity sub-allocation, which will then drive the portfolio 2-3 years down the road. So, this is dynamic.
Correct.
It's not static. What I believe is that this dynamism should always find room in a portfolio.
Correct.
It can find room only in a portfolio. It cannot find room in a one product.
Right.
That is why my whole approach professionally has been around this belief that you are creating a portfolio for people. They buy different products.
Correct.
If they are in mutual funds. You convince them to buy all these products so that it forms a portfolio. Right? In the PMS side, you build and manage the portfolio. You have discretion, full discretion. So, you have that. The reason I chose to walk away from the RIA is the need to convince the other person and the effort to convince that other person is professionally unviable to me. Because at the stature at which I am operating and the scale at which I am operating, I am actually addressing issues which I don't need to address because my conviction is at a level. Investor's conviction is at a level. Investor doesn't want to bridge this gap, however much, and I can't go down to bridge it.
So, combining the portfolios can actually do it.
That is why I said, RIA, I'm going to stop. You come to the PMS and you see the results. You have full control.
Absolutely.
Earlier, I have a lot of frivolous conversation. People ask me so many times, why are you buying PSUs? The same people went and bought defense stocks at the top. Right?
Correct.
Now, should I go and point out that what they did? So, all this is not productive. As an investor, I don't indulge in these conversations even with friends who have a different way of thinking. As a professional, I should not put myself in a position where I have to go and argue with clients and all this. I want to keep away from all that because it is not productive for the client, it's not productive for me. It produces nothing in the investing except difference of opinion. And difference of opinion does not contribute to returns. So, that's why I said that let us do it either in distribution or in the PMS.
So, the outcomes looks like in this year, and it could kind of, this year could be a flag bearer year for this approach. Because
every year is, that's the point I'm saying, from 2009, every year has seen this. This kind of thing has happened.
Yeah.
And you need to always use this approach to shield yourself from volatility and to turn that volatility into your strength.
Yes.
Both. First you have to protect and then you have to flip it and turn it into something that will generate better returns.
Because there are parts of the market that are very expensive.
Always
parts of the market.
Always
Which are very expensive.
Always.
So avoiding all those and going into areas which offer the valuation comfort, which are also supported by the economy, I think that is one of the good ways of taking care of the uncertainty. So a combination of a multi-asset approach, a combination of a valuation-oriented entry approach, I think in these, then we don't have to bother too much about the uncertainty.
See, I'll give you this. So many opportunities. You could have bought a Brazilian fund for 4% and made 100% in some circumstance. We, last financial year, bought and sold a Chinese tech index. Okay?
Yes.
The feeder fund.
Yes.
We bought only to the extent of anywhere between 2.5% and 4%.
Right.
We made, on that allocation, we made 100%.
Wow.
Okay? The portfolio. and we are out. So we didn't sit because we are not really China bulls.
Yes.
So we tactically bought it.
Tactically.
We sold it. And the risk, how much risk you take at the portfolio level? 2.5 to 4%,
yes.
somewhere in that zone. Now, if you can create a delta at the portfolio level of 400 basis points, taking a risk which is only to that extent, then such an approach won't fail as long as your risk taking is correct.
Exactly.
You have to be sure about the risk taking.
Yes.
And take only risk which you can control.
Correct.
Don't take risk which you
size it correctly.
Correct. So this is like cooking, right? So you would go to whatever, Master Chef or something, and you see that people are appreciating some dish, which you know, but that person makes it in a way which is entirely different. Because they layer it with something, some ingredient, something. Investment is also the same thing. In a portfolio, you should know how to create that. Just like a master chef creates a good dish, you have to create a portfolio in which you are going to have some elements, something that will hit you, right? And give you that high, give you a very nice feeling. And it will not be there forever. After you move to something else. So it's a constant activity where you look to do better. You look to right size your positions. You look to take calculated risks, which are well thought through. And you never go overboard to generate outperformance or beta.
As long as you keep on playing this game between risk and return, you don't have to worry about big uncertain times.
You will always err on the side of caution. No, your natural inclination is to err on the side of caution. You will make some errors in the short run. The client gives you some more money. You will invest there where the error is a short-term error. Then over a period of time, it normalizes. And the client starts making money even in that error. So you have to right-size things. You should not make it all about yourself and you should not make it egoistic. Like, in my opinion, a 75% cash call in a portfolio is also a highly egoistic position. Right? 25 is not, but 75 is right? So when do you take that position? So for example, somebody is giving me money at a time when it is not the right time. On the day I start the portfolio, I may be able to only deploy 18%. At one point in solitaire, I was able to deploy only 7%. So 93% cash. But it is not an egoistic position. When the valuations keep coming down, slowly I'm able to deploy because I know what value I want to buy each stock. So the 7 slowly becomes 18, becomes 26, it becomes 32, 38, 45, 46, and it keeps rising all the way up to 100. Now, though we have taken a cash call, it's a gradual deployment. And it is not an ideological cash call. It is a cash call that adapts to the opportunities in my own portfolio, what I want to generate. My portfolio in construction, which I am building for the client, in that I am forced to take a cash call in specific points of time when the market is not favorable. But it turns so fast. Like if you get a tariff tantrum or a India, Pakistan or Iraq, Israel, on those days you'll get 1 hour, 2 hour. In those few hours, we'll deploy 2-3%. So that is how I have done my investing personally. And the interesting part is over the 16 years, I have learned to do that professionally also. So there is a way of doing it. It is not easy for sure. There is a lot of effort that goes for the client. Because otherwise you can just give the portfolio, model portfolio, some dealer will buy the portfolio every morning and hope that the portfolio will perform. I think that level of activity is not sufficient to do well for a client. So my aesthetics remains what I did for myself, what I continue to do for myself. And as I improve my personal investment aesthetics or how I run my process, the same thing I take it to the client also seamlessly. Because end of the day, I feel that the same process should work for a very, very long time. And it should work even if I am not there. Then you have to institutionalize it. You cannot make it personal and sit only in your head. So it requires far more effort to build, but it pays back big time. It sustains. The reason why we give better investment experience to our investors over industry is only because we are doing it with this kind of approach, with this kind of fastidiousness to our investment process, and we are sticking to the knitting. So we don't do any shortcuts to catch up. Suppose the portfolio is underperforming in some short run, I will not go and buy a stock which I can trade and make the 2-3%.
Yes.
I do it on conviction only. Without conviction, I won't do. If I bought China, it was because it was undervalued and it was a contra bet. I didn't buy it thinking that I will make 100% return, therefore I am buying it, and therefore I will correct
the extra.
Yeah, it doesn't work that way. So, that orientation is what we have built and maintained in whatever we have done professionally. Why is it so important? Because that's what worked personally. And is continuing to work. And I know that only this will work.
Yes.
Any other shortcut won't take us where we want to go and we want our clients to be. So this is broadly a framework which we keep on improving but never deviating from. So thanks, Ashwin. I think we have had a very interesting conversation on many things which keep getting asked. I'm sure you are asked these questions by many people.
Yes, absolutely.
Because we also may not be explaining many things so clearly. So we need to do that, and this video was a very useful conversation where many of the things have been put in front of our investors and those who want to invest with us. Thank you so much.
Thank you.